2. Welcome everybody. Again, as you joining in, just drop where you're joining us from. This is a presentation brought to you by the Excite community. Excite community. It's an ecosystem, a secret space that we've created for our members of our community that are looking to expand their minds, expand their knowledge base, and be able to grow wealth, whether it's like starting a side hustle or investing or whatever. Over the last 6 years, 6 years, actually 7 years, over the last 7 years since I started on this journey. If it were to combine with my partners and I, we've invested over $300,000 in education, coaches, mentoring, all kinds of resources in ourselves, from gaining all the knowledge necessary. Because a lot of times as busy professionals, we follow the right track. We go to school, get the jobs, get trained in our respective professions, and we come out and start making a good salary. But that's all we know. We are kind of like narrow-minded. It looks like somebody kicked me out as host. But that's all we know, and we're kind of narrow-minded in what we know about investing, right? And so over this last 7 years, let me just check. Can you guys see my screen? Do I have the right slide on how a self-directed IRA can maximize your wealth?
Yes, but you're showing the presentation mode and the full one, so you might want to just put it on one slide.
Okay, so exit to the end slideshow. Okie doke. So what do you see now?
So I see the presentation, so you can just do slideshow now.
What do you
Slideshow from.
see?
I'm not sure why you're showing both slides.
Okay.
Display settings.
I had it right.
Right, hide presenter view.
All right, guys, having some technical issues here. Just give me a second. Let me figure this out. Think I know what the problem is. Do you see now, Tenny?
Yeah, it is still showing the pop. I think it's better. This is it now. You got it.
All right, sweet. Are you seeing presenter view now?
Yes.
All right, great. Okay, so as I was saying, as busy professionals, we are focused on our career. We get done with our respective careers and we focus on our jobs. And there's a lot that we don't get told. There's a lot of information that's not exposed to us. So over the last 7 years, my partners and I have invested significantly on ourselves. That journey that led us to founding Excite Capital, which is a private equity real estate platform, where we use it to invest in large apartment buildings and able to encourage others to invest there as well. So what we realize is that a lot of this knowledge that we've gained by hiring all these coaches, mentors, and spending all this amount of money investing in ourselves, a lot of our colleagues don't know about it. So the Exact community is created as an ecosystem where we'll be able to share everything we've learned with you, so that you can use it however way you want to use it to grow your wealth, or to gain financial independence, or however way you want to use it, right? And this presentation comes as a result of that. We recently had we recently have a multifamily asset that we closing. We bringing in all these investors on, and as we were talking to investors about how you could invest in these assets, we realized that a lot of our investors, a lot of the busy professionals, do not even know that you could use a self-directed IRA to invest outside of the traditional investment classes, outside of the stock market, which is what most of us know. We know that when you create a 401k, you are restricted to a certain number of accounts or mutual funds or stocks or equities that you could invest upon. But there's this other side to it, like where you could leverage your retirement account and be able to invest outside of the stock market, invest in alternative assets like real estate, invest in cryptocurrency, invest in, like, you could even invest in debt. Like you could give out loans and be able to get like good returns for it using your self-directed IRA. So that's the reason why we're creating this presentation, again, just to share that knowledge so you could use it for yourself and see how it benefits you. So as a disclaimer, I am not a financial advisor. I'm not a CPA or none of that. I am just somebody who is passionate about financial education, who is passionate about learning about how the system works and being able to share that information with others so that they could use it to grow well for their families as well. And so don't take my word for it. Go back, do your own research. This information is public knowledge. Just use this presentation as like a an opening in your mind to new information that you could go in and dig in more, learn more, and then take advantage of it, use it so that you could grow wealth for yourself and your family. So as you can see, my name is Leslie Awasum. I'm one of the founders of Excite Capital. Excite Capital was founded by myself and these two dapper gentlemen that you see on my sides here. Are they not just so dapper? You can see Tenny over there with a black suit and trying to fake a smile, you know. The amazing partners that I have. Our CEO, Dr. Julius Oni, who's an orthopedic surgeon. Together, we founded Excite Capital Investments in 2019. When we came across the asset class of multifamily investing and realized that a lot of members of our community do not even know that you could have access to this asset class, realizing that this is an investment vehicle that provides double-digit returns in a safe way, in a safe and predictable way, and realize we did not even know about it. So who else didn't know about it? So we created Excite Capital to go out there, spread the gospel of multifamily investing, and so that we could help others as well, so that they could be able to grow their wealth as well. So that's where Excite Capital was founded, and these are my two amazing partners. And I gotta say, I am truly blessed to have these guys, these two amazing gentlemen by my side on this journey of growth and the amazing team that we've created here at Excite Capital. And I'm telling you, like, isn't it just wonderful to have other people that think in the same wavelength as you that you could go on this journey with? It is great, you know. So that's what the Excite community is created for, so that we could connect to each other, learn from each other, and continue to grow. So as I was doing research, as I was talking to investors and came across this realization that a lot of people do not even know that there's something as a self-directed IRA that you could use to invest outside of the stock market. I went back and was digging more. Then I saw this stats. I forgot to mention the source, but it's a stat right off. I got it online that says that as of May 2023, there were about 29.2 million forgotten 401k accounts, right? Which held about $1.65 trillion in assets. That is your hard-earned retirement accounts that you have sitting somewhere. A lot of us in our professional careers have moved from one job to another. A lot of times when we move, we don't even realize that we have a retirement account over there. We just leave it there. And in most cases, it defaults to one of those long, what is retirement plan, retirement by 2045 or 2065. Those plans, it probably defaults to that, not being managed. It's just over there catching dust. The returns on those plans might be negative, or it might be average of the S&P 6 to 8, but it's just sitting there. You don't even know what's going on in there, right? But that is your hard-earned money that is as sitting over there that could be better managed, right? And a lot of us don't even know we have this. It's interesting because as I was doing the research for this presentation, and I was talking to my wife about it, she was like, "Oh yeah, babe, you know, I have this other account that because she used to work for the correctional, she's a nurse practitioner. She used to work for the Maryland State Corrections, female corrections center as a nurse practitioner, and she was there for a short period of time, so she had a small retirement account over there that has a few $1,000s, and she has completely forgotten about it too. It's sitting there not being managed. But guess what? Now we are about to roll that over. to a self-directed account where we can use it to invest in other assets and stuff like that, and really be able to capitalize and push the growth of those accounts. So if you're on this call, and you have an old 401k plan, or you know somebody that has left a job and has an old 401k plan, you want to tell them about this, because they could really capitalize on the power of a self-directed account in order to be able to grow their wealth. So today we're going to be talking about what a self-directed retirement account is, um, how you could use a self-directed account to invest in other assets. Talk about some IRS regulations and best practices. And again, this is based on my research. Go back, do as much as you need to do. And we're going to go over some frequently asked questions, and I'm going to answer the questions to the best of my abilities at the end of the presentation as well. So let's get right into it. So what is a self-directed account, right? This is a type of an individual retirement account that gives the investors greater control over what they choose to invest in. As I mentioned, your traditional 401k plan limits you on the kind of assets that you could invest in. Even when you go to your 401k and you cannot pick individual stocks. You're limited to mutual funds and ETFs that you could invest in. According to the people that created the 401k plan, that is supposed to be safer, and a lot of investment advisors will not tell you that you could also create something that is called a self-directed account that you can manage yourself and choose to invest in whatever you want to invest in, because they don't make a lot of fees from this. They don't get a lot of the benefits as being in the managed accounts that they do, where they trade every trade they make money from the fees on you. So a lot of advisors will not tell you about this, right? So, but you as an individual have the ability to have a self-directed account. It's the law. I think the 401k came into effect in 1974. It was the ERISA Act of 1974 that established the 401k plan. And in that act, it also allowed for some level of self-direction, but that did not really go into effect until I think it was 1986, where there was a lawsuit challenging, because a lot of institutions were not allowing people to self-direct their accounts. And there was a lawsuit that was won that allowed for this stipulation where you could create a self-directed account. The lawsuit was in 1986, but these self-directed accounts did not really become popular until 1996. Since then, even till now, it's just a small portion of the retirement accounts that are held in self-directed accounts. Most of them are still held in like 401k plans that are controlled by larger institutions. But more and more people are learning more now about the ability to be independent, ability to be able to manage their own retirement, ability to invest outside of the stock market to be able to get better returns using a self-directed account. So I was fascinated that a lot of people, a lot of our investors did not know about it. So I'm hoping to bring this to your awareness so that you could take advantage of it. So some of the key benefits, some of the key features of a self-directed account is like it gives you a broader investment options, or instead of like traditional IRAs, the way you kind of invest in the stock market and stay in the stock market. It also gives you greater control over your investment choices, and you have the true potential for much higher returns and true diversification. And when I say true diversification, what does that mean? I know when you go meet your financial advisor, they tell you you need to diversify your portfolio, diversify across stock classes, maybe do medical, do agriculture, and do other things. But according to Ray Dalio, who is one of the greatest investors of our time, that is not true diversification. According to Ray Dalio, what he calls the holy grail of investing is diversification. And by diversification, what he means is you need to have 10 to 15 uncorrelated investments so you can reduce your risk by 80% without decreasing your return. So you can actually increase your return to risk ratio by a factor of 5. And what does he mean by uncorrelated assets? These are assets that are not correlated to the stock market. These are assets that you could invest in outside of public markets. So I know about a few weeks ago, we heard about the stock market dipping. That kind of dip does not affect these assets that are not correlated, that are uncorrelated to the stock market. So that's true diversification. And when you're able to do that, you significantly decrease your risk and increase your reward potential. So, and that is what a self-directed retirement account allows you to be able to do. You're able to use your retirement account to diversify out of public markets into different assets that are not correlated to each other. So that way you can maximize on your return potential and achieve that retirement dream, whether it's living on the beach somewhere or just traveling the world. You have the potential to do that when you leverage your retirement accounts to invest in assets that grow much faster than public markets. And these are examples of some of the assets that you could invest in. You can invest in real estate. You could do private lending. You could invest in precious metals. You could have some gold, silver in your portfolio. You can invest in private equity, right, and private stock. And you could invest in multifamily commercial real estate. And guess what? You could invest in cryptocurrency as well. I know there's some people here that are really, really passionate about cryptocurrency. Manny, I'm not talking about you. Guess what? You could leverage some old retirement plans and buy some Bitcoin and buy Ethereum with it as well. So you have access to that. It is your money. You get to decide how you want to invest that money. So when it comes to like the self-directed IRA, there are two main types, right? There's like the custodial IRA, self-directed IRA, and there's the checkbook self-directed IRA, right? The main difference, one of the main differences is that with the custodial self-directed IRA, it has to be managed by an IRA custodian. That custodian keeps the money, manages the money, and when you need to invest in something, you make a request to the custodian. The custodian sends out the funds to what it verifies that investment qualifies for you to invest in, then sends the funds to that investment, and then all the returns comes back to that. The custodian oversees the account and make sure that you're meeting all you're tax compliant and all of that, right? Whereas a checkbook IRA, you have way more control over a checkbook IRA. Right? With a checkbook IRA, you do work with a custodian, but you work with a custodian really to set up an LLC, right? And an LLC, then you're able to open an account for that LLC in the bank, your IRA LLC, you open an account in the bank. That account is managed by you, right? This is really, really good for people that want to do like real estate, active real estate investing using their IRAs because you're writing checks and you're able to pull out capital all the time. So you have access to that capital much faster, and your returns go back to that. So here are some key differences, right? So you have direct access when it comes to the checkbook IRA. You have direct access to the funds, whereas for the custodial IRA, the custodian manages it. For custodial IRA, is really good for investors that want to be passive. The custodian manages it. The fees are still lower than a traditional 401k. With the checkbook IRA, fast speed, you can write your own checks, and custodial is slower. You got to put in the request and it gets processed. And now with the checkbook, fees are typically lower because you manage your own transactions, you keep your books, you don't have to pay a custodian for any of those services. And but it does require an LLC setup, whereas for the custodial IRA, the custodian takes care of all the admin tasks and all of that. So as you can see here, the checkbook IRA is really good for active investors seeking fast, direct control over their investments, whereas passive investors, the custodial IRA works really well for them as well. So when you're doing a self-directed IRA or self-directed retirement plan, you could have a self-directed IRA as a traditional IRA or a Roth IRA. So guess what? If you currently have a Roth IRA right now that is not self-directed, you could roll that over to a self-directed Roth IRA, and you're able to invest outside of the stock market, right? And you could use it to invest in like private real estate. You could use it to invest in private equity. You could use it to invest in other assets, and it grows that way. And then most of your benefits, like your growth, remains tax-free, unless if you're investing in like an active business where you get charged, I think it's UBIT tax, which is it's still lower than the traditional tax, but you get taxed on the gains where if you invest in an active business using your Roth. But for like passive real estate investing or anything like that, you invest using your Roth, all your gains stay tax-free, right? So you don't get to pay taxes on all your gains. So guys, that is a powerful way that you could really accelerate the growth of your retirement account. So you have a Roth IRA, you change it into a self-directed Roth. You could use it to invest passively in real estate assets and other assets, and all of your gains remain tax-free, right? For the traditional IRA, your gains are tax deferred until you get to the retirement age where you're able to pay taxes from it, or when you get to the age of 72, when you are required to do like a minimum distribution and you get to pay taxes on that as well. So truly, truly powerful tools that you could use to really accelerate your retirement. Now, another type of self-directed retirement account is a solo 401k, right? For a lot of you, my CRNA colleagues that are 1099, 100% 1099 right now, this is for you, right? You could create a solo 401k. I think the requirement is like you have to be like a sole proprietor, self-employed, or have a business where you don't have another employee, you the main employee, and you're able to you pay yourself you pay yourself from that business, right? So it's like the 1099 employees or self-contractors and all of that. You could create a solo 401k, right? And the solo 401k allows you to defer, like to invest way more than the traditional 401k, right? As the business owner, you could invest up to $66,000 a year in your retirement account. And guess what? You could use this, you direct the retirement account. You could use this retirement account to invest in other assets. You could use it to invest in whatever you want, right? There's some prohibited transactions for both self-directed IRA and solo 401k. I'll talk about some of them a little later, but you have control over this account and you get to decide whatever you want to invest in. And as a solo account, you get to be able to defer a whole lot more income, right? So this is powerful stuff. This is powerful stuff because imagine you had $500,000 where you have it somewhere, you're sitting and it's getting you maybe 15, 20% return annually. That $500,000 is going to grow so much faster. Let's say after 5 years, you get 20% return on your $500,000. Now, math, I can't think of the top of my head right now with the math, but you get to whatever exit on your business plan. Let's just say that account has grown to $800,000. Now that account remains tax deferred, and if you decide to reinvest that 800,000 in something else that is generating 20% every year, now your $1,000,000, your now you're getting 20% return on 800,000, all tax deferred. So this tax deferment allows you to have a higher check going into the next investment, allowing you to be able to accelerate your wealth much faster. So if you're a 1099 employee out there, take advantage of a solo 401k. You can establish it by December 31st of the year. There's no annual filing fee unless the plan has assets above 250,000. I know some of you might already have it. And guess what? You could also borrow. You could take a loan out of your own solo 401k. You could take a loan up to 50% of the account, or $50,000. So you have the power to have control over your retirement account, and you could use it to leverage, use it to invest in assets that will really speed up your growth, right? So in summary, these self-directed accounts give you access to greater investment flexibility. They gives you the opportunity to do true diversification, like Ray Dalio explains, right? Truly diversify outside of public markets. You have the tax advantages, you get tax deferment with the traditional self-directed plans, and you have the tax-free gains with the Roth self-directed plans, right? You have a potential for higher returns, and I'm going to show you some examples why. Because all we know are public markets, and 8 to 10% is not bad. But guys, believe you me, there are other assets out there that other investors are using that are not smarter than you, that are earning double that, triple that on a yearly basis, right? But because we are not taught this, we don't have access to it. And you have control over your own retirement portfolio. And yeah, you can use it to build wealth through real estate and create long-term wealth, So let me give you a true example of how powerful this is, right? One of the reasons why I'm here today and having this conversation with you is because of what happened, what I experienced in 2008 as a new graduate nurse doing my orientation. I saw my preceptor lose a significant portion of our retirement in the 2008 stock market crash. She had to postpone her retirement because of that. I left that day with a very unsettling feeling, not understanding why someone will have to work that hard for all those years and do what they're supposed to do the right thing according to what they were told. And all of a sudden, in one day, that disappears. Just like that, everything you worked out for disappeared. And I was determined to not let that happen to me. And that was that journey, that was that curiosity that sparked all this interest and pushed me into learning about all this stuff about finances. And now I find myself here in this journey, and I'm so passionate about sharing this with you. So um there's a period in the stock market that is referred to as the lost years. That is a period from like 2010 to maybe 2000, sorry, from 1999 to 2012, right? Because during those years, anybody that had any money sitting in the stock market during those period of time, you pretty much had zero gains on average, because the peaks and the lows averaged out to zero. And this is a good example here of somebody that had this is an example of somebody that might have had like $1 million in their retirement account starting in 1998, and they held it to 2010. You could see how the account goes up and down. You know, they always tell you just leave it in there, it's always going to come back. Yes, it does come back, but how long does it take for it to come back? The thing is, the dips affect your account way more than the peaks, because as you can see, 1998 to 2000, this person's account was at 1.5 million from $1 million. 2000 to 2002, 50% drop. And it's so crazy how these drops happen. It can happen in a single day or a week. Like your account goes down by 50%. And the advice there, just leave it in there. It's going to come back. It's going to come back. And yes, it did come back, right? But from 2003 to 2007, you're back up. You're smiling, right? That is where my preceptor was, right? She was smiling. Okay, I've recovered some of the losses that I had right now. I'm at this point. I need to grow again even more. She was already planning her retirement. And guess what? 2008 happened. Another 50% drop, right? Now she had to postpone her retirement, right? Now between 2009, 2010, it came back to where it was starting in 1998. Now that's what happened in the stock market. You know, we are told always leave it in there, it's going to grow. And that is true. Over time, it will grow. But the question is, what is your timeline? What timeline are you in? Are you close to retirement? Are you already there? Like, do you have 20, 30 more years? So those are some of the things that we have to think about, you know, that we're not thought. So you have to think about that and be able to figure out how you could truly diversify your portfolio so you protect against the downsides, right? Now, check this out. For that same period of time, right? So for that 12-year period of time, you saw what happened, and I just went over the scenario. Now, for that same period of time, private equity, right? Private equity had an average annual return of 12%, which was one of the lowest periods of time for private equity returns. So why the stock market was pretty much averaging zero, private equity over that period of time averaged about 12%. Now see what that does to that same $1 million. By 2010, that $1 million is almost $4 million. And that is during a period which is referred to in the financial industry as the lost years. So even in the lost years, private equity was averaging about 12% average annual return. And again, you know, you hear private equity sounds fancy, but it's not rocket science, guys. Like a lot of you, you take care of people, you bring people back from the dead. My anesthesia colleagues do that every single day. So private equity, you too can invest in private equity. You qualify as accredited investors, but you just don't know that you have access to this. Now, being able to capitalize on your self-directed account, you are able to invest in this, diversify so that you could protect your investments on the downside. So that is the power of being able to invest outside of public markets. That is the power of the true diversification that Ray Dalio was mentioning, because with private equity, you invest in uncorrelated assets in most cases, assets that are not correlated to each other. And by doing that, you're able to protect on the downside and increase on the upside, you know. So now let's look at what that looks like. Again, another chart when you're comparing the stock market to real estate. You can see Everybody knows real estate always increases in value, so I don't need to overemphasize that. But this is another chart of the Dow Jones Industrial that shows like the time period I'm talking about, how different time periods affect people differently. So you can imagine, this is somebody too that was just following the traditional advice and saving in all their money, waiting in for those 20, 30 years so that they could retire. You see, the peaks are really good to watch your account go up, but when it drops significantly. Now, if you find yourself at the end of retirement when it's down this low, it's not a good position to be in. It's not a position that I wish for anybody. When I talk about this, I still picture the face of my preceptor, how flustered she was when she came back from talking to her husband after receiving that call. And again, I don't wish that for anybody. So this is another chart which has like a comparison between private equity and public stocks. And guys, here's one statistics I found out in my research. In 2021 was a record year for private equity returns. Private equity investments return an extraordinary 54%. 54% return. You guys remember what happened in 2021? COVID hit, there was a stimulus, a lot of money was pumped into the economy. The stock market did well too. I think the stock market was in the 20s or high 20s or whatever. But guess what? Private equity was in the 50s, right? Because guess what? That's where most of the wealthy and the savvy, that's where they invest in. And a lot of that money that got pumped into the economy went back to those hands, right? And they used it to invest in private equity, and they were earning 54% return in 2021. Imagine what a 54% return would do for your own retirement account. And you have access to this, right? So take advantage of it. Use this presentation as an opportunity to expand your mind and learn, and go take advantage of it. This is another case study of how private markets differ from the stock market, right? This is the same thing. You can see 2021, like I said, the stock market went up too, right? But this is private real estate. This is one of our assets that we own during that period of time. You can see what the returns were like for $100,000 investor. In that same time, if you had invested in the stock market, you would have seen your $100,000 increase. Oh my God, 20%. We are 120,000 in September. And then guess what? Started going down, right? If you see the dips again. In that same period of time, a private real estate investment like a multifamily property, slowly, as a business plan is implemented, you acquire the property, it's probably flat. Business plan is implemented, it keeps going up, keeps going up, keeps going up, then the appreciation shoots. And guess what? The investors in this asset ended up with 29.97% average annual returns. And I am so proud. I'm so happy because some of my CRNA colleagues actually invested in this. One of them invested over $300,000, and she made like 29.97% annually on that money. So that is how you're able to leverage. And she used a self-directed account to be able to invest in that. And that is how you're able to accelerate the growth of your retirement accounts, right? So there are a lot of rules that go with this with the IRA investments. There are certain things that you cannot do, right? So there are prohibited transactions that you cannot do. For example, you cannot do a transaction with your close family member. I don't want you to get too excited about IRA and like, oh my God, I just unlocked something here. I'm going to use my retirement account to buy my sister's house. No, the IRS will not allow you to do that. You're not able to do transaction with somebody that's a close relative, and you cannot use it to buy your own house. And there are other prohibited transactions as well. So the general steps to set up like a self-directed IRA, if you wanted to invest in real estate, for example, you start by choosing a qualified custodian. Then you decide whether you want to use a checkbook IRA or you want to use a custodial IRA. If it's a checkbook IRA, you got to create an LLC, open a bank account for that LLC, and then you're able to fund that LLC in that bank account. Some of the things you cannot do with that LLC is like you cannot get a credit card for that LLC. So you can only do a debit card, and I don't think you cannot take any loans with your IRA, like personal loans or anything like that, because that's gonna I think that's gonna he's gonna make the IRA lose all its tax advantages. So familiarize yourself with these rules, and or ask the custodian, whichever custodian you decide to use, ask them to provide you with the rules and what is prohibited, what you can do with your IRA investment. Then once you have the funds ready, you research on whatever potential real estate you want to invest in, evaluate the properties, look at the criteria, cash flow, whatever. If it makes sense to you, then you can invest, right? If you are investing, let's say if you are using your IRA completely to go buy a property, right? Your IRA is contributing 100% of the down payment. That property, the loan on that property has to be a non-recourse loan, right? That's one of the restrictions. But you could use that IRA to invest as a group, as part of an investment group as well, on different assets. So that's just one thing to pay attention to. So some compliances and best practices. So you want to avoid dealing with your IRA, like any prohibited transactions. You want to avoid any kind of personal benefit, or like I said, using your IRA to buy your own property. You cannot transact with family members or fiduciaries, and any kind of violations might lead to like disqualification of your IRA as a tax shelter, and you're gonna have to pay taxes on any of the gains that you made from those transactions. So every year, if you have a custodial IRA, every year you want to file a form 5498. A lot of times, like, your custodian helps with that, and whatever asset that you're investing in, you have to report the true market value of that asset every year. So that's where that form 5498 comes in. For all those that are using self-directed IRAs to invest in our deals, we make sure that this gets taken care of you in a timely manner so that you stay in compliance with your IRA as well. So you want to choose a knowledgeable custodian. Now that you know what an IRA can do for you, you want to choose a knowledgeable custodian, conduct thorough due diligence before investing, and keep your personal and IRA finances separate. You don't want to commingle. When you commingle the assets, then you lose that protection as well. And these are some of the things that you cannot do with your SDIRA. And there might be more, but this is the list that I was able to find with my research. Guys, are you understanding me so far? Are you getting this? All right. Are you about to go jump in and start creating an IRA to make money? I love it. Love it. Love it. Great. So you want to use you cannot use your IRA for personal property, right? You cannot use it to have any transaction with somebody that's a family member, your child, your parents, your spouse. Um, you cannot personally benefit from the SDIRA, self-directed IRA investment, meaning you cannot earn like income, like you cannot charge your IRA salary or consulting fee and start paying yourself as a consultant, right? You cannot lend money, you cannot borrow money to yourself or to a family member or any disqualified person. And the other interesting piece is, like, you cannot invest in collectibles, unfortunately. So you cannot go buy that nice car, that collectible car, or telling you cannot use this to buy a Rolex watch thinking that it's a collectible. So that's not allowed under IRS rule. So any kind of collectible items like art and all of that, so you cannot use your IRA to invest in collectibles. You cannot use assets that are held under your self-directed IRA as collateral for personal loan as well. And one of the interesting thing I learned is let's say if you use your IRA to buy a rental property, for example, then at some point you decide, oh, I want to move into that rental property and make it my personal home, right? You're gonna have to have your IRA sell that property to you. And I think all the gains that you've had in that house or something like that, you have to pay taxes on it. But there's a way you can do it, where you're able to transfer that property from your IRA to you as a person, but there's some tax liabilities to it. And you cannot contribute more than your annual limit to your SDIRA, or it may lead to some penalties. But as you know, if you are a 1099 professional, you have a lot that you're able to contribute if you use a solo 401k. And you cannot pay a company you own or work for to provide services. Again, this is like you're trying to double dip. You have an IRA and you create a company and say that is servicing the IRA, you pay yourself. So again, just avoid any of these transactions that are in the gray area, you know, it's a great tool for you to use to invest and grow your retirement, accelerate the growth of your retirement over time. You know, so you want to protect it, make sure that you do things the right way. And as you know, it provides great tax benefits. For traditional plan, your tax benefits are deferred, which you could use it to accelerate the initial value of your account over time. You have investment flexibility. As a self-directed account, you can invest in a bunch of different assets, so you could diversify your portfolio, truly diversify, like Ray Dalio says. And you just want to make sure that you understand that you work with a qualified custodian that keeps you in compliance and manages your account very well. So some frequently asked questions, which I've personally encountered from talking to other investors or from doing my research about this account, is like one of them is like, for example, you plan to buy a rental property with an IRA. Does rental income have to go back into the IRA? Absolutely. Your IRA is an individual on their own. So any kind of returns go back directly to the IRA. This ensures that you retain the tax deferred or tax-free status. For all of our investors that are using an IRA, all of your cash flow goes back into your IRA and it stays in the IRA. So when you sell a property owned by my IRA, may I keep a portion of the proceeds and send the remaining portion to my SD IRA? The answer is no, unfortunately. All the income generated from sale of a property owned by your IRA must be deposited into your IRA account. Can you use funds from your IRA to renovate a property to sell it at a higher price? Yes. However, your IRA must pay all expenses associated with the property that it owns. Further, all proceeds from the sale of the renovated property must be deposited into your IRA. So you could actually use your IRA for flips, although there's a little bit of a taxation. There's a tax that will apply, partial tax that will apply to some of your benefits, but you could definitely use your IRA to flip properties. So how do I pay funds to the seller? You must instruct your custodian where to send the funds from. So let's say, for example, I'm investing in an asset. Like I'll give you an example of our investors that use IRA. Their custodian reaches out to us. We let them know what the account they need to wire the funds into. And once the funds are received, we confirm that with the custodian so that they could confirm the investment as well. So can my IRA purchase real estate that my corporation, partnership, or LLC owns? Again, no. This is like doing a prohibited transaction, because that's somebody that you pretty much doing a transaction with yourself. So can my IRA purchase real estate that I currently own? Again, the answer to that too is no. It's considered a prohibited transaction because you cannot buy it from yourself. And am I restricted to only purchasing residential property with my IRA? The answer is no. You're not limited to only residential real estate. You can use it for commercial buildings, vacant land, condominiums, mobile homes, apartment buildings, or other residential properties. So your IRA gives you the versatility and flexibility to invest in various types of real estate. So you want to capitalize on it. So first of all, I want to thank everybody that has stayed all the way to the end of this call. These are some of the IRA custodians that we're familiar with. There are many more. There are many, many, many more. Before you use a custodian, make sure you do your own due diligence. Talk to the custodian, to the company, ask others that have used it, know what their fee structure is, and ask them great questions. You know, ideally, you want to use a custodian that offers both a checkbook IRA and a custodian IRA. So that way, if you need both of those accounts, you can work with the same custodian. So these are some of them that we work with, and we work very well with Advanta. We work very well with Preferred, Equity Trust. We have investors with Madison Trust, Vantage IRA. So these are some of the custodians that you could use to self-direct your retirement accounts, and you're able to capitalize on the great returns that it provides. And for all of you who registered for this event tonight, and all of you that are members of our community, you're going to be getting a free ebook, an IRA guide ebook that we created that you could use as a guide as you go about to set up this IRA account. So guys, again, this is a powerful, powerful, powerful tool that you could use to accelerate your retirement. You could use to accelerate your wealth growth. So take full advantage of it. if you have old 401k plans that are sitting over there catching dust, roll it over to a self-directed IRA and learn about some of these other asset classes that you can invest in. Capitalize on it, use it, grow your wealth, accelerate your wealth growth. Don't be comfortable with the 6 to 8% when you have access to assets that could give you 12, 14, 15, or even 54% average annual return, like we saw what private equity did in 2021. So on that note, I'm going to wrap it up right here and open it up to questions. All right. Anybody, any questions? You could drop your questions in the chat. You could drop your questions in the Q&A. Yep, that's right, Tim. 15% is 75K per year. That's for $500,000 investment. That's a lot. That's a lot of money that you're making passively on your investment. So you can imagine just imagine that same $500,000 investment and you're making 54% by investing in a private equity and be able to make those kind of returns on your money. Talk about true acceleration to retirement. All right, Tenny, any questions?
Nah, I'm looking at the chat right here. I think Tim already asked. Let me see. And you answered some of those questions already that was frequently asked. Let me see on
Do we have any questions on LinkedIn? Whoever is monitoring the LinkedIn live.
not in there.
Right. Yeah, we also live on LinkedIn. And guys, again, this is like the first presentation that we're doing on our community. Every week we're gonna be coming on doing a presentation on different topics where we're providing value. Again, capitalize on it, use it, leverage it to grow wealth for yourself and set yourself up for like a great financial future. Whether you're trying to invest or whether you're trying to start a side hustle, we're gonna be sharing all the resources that have been very, very valuable to us. Like I said, some of these resources we had to invest a significant amount to get access to, and we're going to be sharing it with you so that you could take it as business, you could start your business, and learn from us, learn from our mistakes, so you don't have to make those mistakes. If we start telling you some of the stories about some of the mistakes we've made along the way, some of the lessons we've learned, it's gonna be like a 2 hour, 3 hour presentation. So yeah, Adi, I don't know if you're online, if you wanted to just show like some stuff on the presentation. I see we have a question here about what to expect in syndication with yesterday's Fed decision. Oh yeah, that's a really good point, which I forgot to mention during my presentation. You guys heard, right? With the Fed decreasing interest rates. Everybody on this call is familiar with that. Yeah, so as you know, over the last 24 months, 24 to 36 months, the Fed went on like an interest rate hike spree, like unprecedented. Never before in history have they seen that kind of increase in interest rates. But that was done in order to curb inflation. So interest rates went significantly high. And what that means for like multifamily investing or real estate investing is the cost of debt, which usually constitutes about 70 to 80% of the transaction cost for a real estate asset, went up significantly. Like we're talking about from zero interest rates to about 5, right? So or 5.25. So we had people that had properties with like a floating rate debt, started off with a zero Fed funds rate. Maybe their interest rate was about 3%. Then the Fed went on an interest rate spike, right? And it went to like 5.25. So your interest rate left from 3 to 9%. So imagine having a loan on a property of about $10 million and you paying an interest rate on it annually of 3%. That's about what is it, $300,000. And now that interest rate went to 9. So your debt cost tripled. Like your interest, the interest on your debt cost tripled from like 300,000 to 900,000. Now imagine somebody that bought a property and did their calculation diligently and looked at the interest rate and did their calculation and had their cash flow, were very happy based off of that on a 3%. Then the interest rate went to 9, how that affected their deal. So there are a lot of assets that have struggled because of that, and that significantly affected the price of these large apartment complexes. So like Brian Berg, we had Brian Berg on our platform a few weeks ago, and he showed a chart that showed that multifamily properties dropped in value by 35%. One of the main reasons why those assets dropped that much in value is because interest rates went up. The cost of debt went up. When we buy these apartment complexes, we use about 70% in debt, right? And there's an interest on that debt. So if that interest went from like 3% to 6 or 7, then the value of that asset decreases. So we've seen a significant decrease in the value of multifamily assets. I do personally believe that we have hit the bottom, especially with the Fed signaling a change in policy and being able to start decreasing interest rates. We are not going to see like an immediate rise in multifamily prices. No, there's usually a lag effect, and that lag usually lasts about a year. Where it's about a year, then you start seeing the changes in the market. And within this year period of time, they're predicted to be more interest rate cuts. So what that is going to happen is going to put a pressure on cap rates. And I was reading one article today that said there's about 200, like these funds, this private equity funds that I'm telling you guys make all these crazy returns. They are raising billions of dollars, $250 billion, $100 billion to invest, to capitalize on what is happening right now, to get into the multifamily space or in the commercial real estate space and buy some of these assets at the 35% discount that we're seeing. Like I was having a conversation with a friend today, and I was telling him, like, I wish there was a way that I could really take this information that I have in my mind that we see happening and explain it to people in simple terms so they could really understand the opportunity that is out there right now. Like the opportunity, the amount of wealth transfer that is happening right now in front of our eyes. And a lot of people are blind to it. Like we are talking about prime assets that cater to a core human need in prime markets that are poised to grow in what is still considered the strongest economy in the whole world, and that is predicted to even accelerate in growth with the whole technological boom and AI that is happening over the next few years. So we're talking about prime assets in this market, in this economy, that are 35% discounted right now, right? And we are sitting and looking at it and not taking advantage of it. I am telling you, there's so much opportunity in this space out there. If you are not, if you are not, right? If you are not investing in these assets yet, now is the time to go out there, do your due diligence, learn about it, use whatever resources you need to use, and diversify. Put your money in these assets because these discounts we're seeing, we're not going to see them again in a long time. I remember 2008 when all of this stuff was happening, the real estate market crashed and all of that. I'm here in Maryland. My sister owned a condo somewhere in the Langley Park area, and her whole building was foreclosed upon. Like the whole everybody in there was foreclosed because the loans were crazy, and they were selling those condominiums for $10,000. I was so afraid to buy. Like when Brian Burke said that real estate and stocks are the only two assets that people are afraid to buy them when they're on sale, it is real. Like the way our minds have been formatted is crazy, right? And those are some of those tools, those are some of those lessons that we'll be sharing with members of our community so that you could learn to be able to spot opportunities and not be carried away with the fear. Because it's that fear that keeps us, we like, oh man, things are going bad. But that is when private equity moves in. That is when all these savvy guys move in and they scoop up these assets for next to nothing. And in 3, 5 years, they are on a plane somewhere going to Bahamas, Cayman Islands. And we are here worried about what Donald Trump said or what this other person said and fighting each other about whatever positions that we stand with. So again, the information is out there. It's not rocket science. You can learn from yourself and take advantage of it. So yeah, so we expect asset prices to increase over the next 2 to 3 years. So now is the time to jump in because things are highly discounted. Tim asks, months ago, the high interest rates were causing deals not to debt service. Do you think lowering of rates will come down to get deals back in line with debt service coverage ratio? Oh yeah. The reason why deals were not debt servicing is because the prices are not adjusted, right, to meet the interest rates, right? There was like a seller buyer disconnect. The sellers were used to the prices for like 2021, 2020 when interest rates were zero and prices went up like crazy. So the sellers were still functioning with those with that mind frame, right? But as a buyer, as a disciplined buyer, I'm looking at debt service coverage ratio, I'm looking at the interest rate, I'm looking at the cash flow, and at the price that you're trying to sell this for me, it doesn't make any sense. That is why it took us at Excite Capital over 18 months to find a deal. We reviewed over 2,325 deals in order to be able to find the deal that we currently have right now. Because as a disciplined investor, you want to make sure that you're buying a deal that cash flows. So in that kind of climate, it takes time. Finally, prices are adjusting right now to where the interest rates have been over the last 12 months. And that is what I'm referring to when I'm talking about a 35% discount. So now things are highly discounted. Everybody's afraid to buy, except like the smart funds and the private equity funds that are pouring in money. Blackstone just bought like a bunch of apartment complexes in the Atlanta market already, and they're buying even more. They have billions upon billions of dollars to buy even more. Again, so a company like Excel Capital is just a very, very small fish in a much bigger pond. But we are hoping that we could catch a little bit of this wave as well and grow and become that Blackstone of the future too someday. So yeah. So yeah, so we're gonna see some prices come down and better debt service coverage ratios. All right, guys. It is 6:59. That is almost 7 p.m. Addie, do you want to come on real quick and just show, like, just walk people to the community or maybe share the community and I just walk through it before we wrap up? Is Addie on?
Yo, we need to invite him to the panelists. Let me see if can
I don't see Addy on. Anyway, so in any case, Excite Capital has created a close-knit community on a platform called Circle. If you get an invitation that says you need to create an account and create a password, if you're already an investor of Excite Capital, you get a free account. As long as you stay an investor with Excite Capital, your account is free. We have a course over there, a paid course, which is available to all the premium members. You get it for free. We're going to be offering a ton of value. We already signed partnerships with a bunch of other companies where you're going to be getting a ton of discounts. The whole idea of that is like if you're looking to start a business, we want you to be able to save a ton of money on some of the services that we had to spend a lot of money for in order to be able to get our business started. We have all of our resources. You have access to our resources, our lawyers, our property managers, accountants, or whoever that you want to use to grow your business. Again, this is the ecosystem that we want to build of other busy professionals that are looking to grow wealth or looking to start a side hustle. So the community is there. Share it with your friends. Invite as many people as you want over there. This is our very first presentation that is for the community. Next week, we're going to be doing another presentation. If there are any topics that you want to learn about, maybe starting a business or doing something, any topics that you want to learn about, please drop it with us. We will create the content for you. Again, it's our place for you to get as much value as much as possible. We want a close-knit space because a lot of times and in the internet world that we're in right now, a lot of stuff gets lost in translation. So this is just for serious people that are serious about growing, about really growing their wealth and thinking outside the box and having access to these resources. So you know any of those people, please share the invite with them. And there's some special benefits for people that invite more people to the community as well. So again, without any further ado, I'm going to wrap it up. I just want to say thank you for giving me your attention and thank you for being part of the Excite community. We truly appreciate you. We're grateful for you. There's absolutely no reason why we should be doing this if it wasn't for you. And again, thank you so much because you all inspire us to continue to keep working hard and continue to provide value for you. So thank you very much and have a good night, everyone.